Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button and ring the bell so you don't miss our daily interviews with successful real estate investors. Our guest today semi-retired from the corporate world in 2012 and moved his family from Wisconsin to South Florida. After it became apparent that his wife and high school-aged daughters didn't want to live on a sailboat and cruise the world, he decided to start over, but as an entrepreneur. He specializes in showing real estate investors how they can leverage high cash value life insurance policies to build more wealth than they could have by simply investing in real estate alone. Tom Rutkowski is president of Innovative Retirement Strategies. Tom, welcome to Purchase to Profits. It's great to have you on the show.
Thank you for having me.
Yeah, I'm really looking forward to this because you're going to be able to give us some a unique take on life insurance policies. I'm sure many of our viewers don't realize that are there.
Yeah, you're looking forward to a conversation about life insurance?
Hey, well, you talk about leveraging policies to get more wealth, so I'm interested right off the bat.
That sounds good.
Yeah, and hopefully your personality can take us through the boring parts.
I usually have some very fun conversations. Most of the people who find me online have watched all of my videos. They've read all my articles and blogs. So they come to me with a very good understanding of life insurance, and all I need to do is fill in the blanks. So I have fun conversations with very smart people, every day. My job is awesome.
That's great. But before we get into the life insurance, I have to ask, why didn't the family like sailing around in the world in a sailboat? Like, what was wrong with that?
I know, right? My older daughter was 10th grade going into 11th, and my younger daughter was going from 8th grade into 9th grade, freshman year of high school. And for whatever reason, they just did not like the idea of one, being homeschooled, and two, missing out on high school.
Yeah.
My older daughter, once we were down in Florida and she finished up high school, she now lives on a sailboat in Key Largo on her own. Go figure, right?
Yeah. Well, I guess when they're teenage, the internet connection isn't so good on the waves. So
right.
Yeah.
Well, I don't think it would have worked out anyway. My wife really doesn't do well with the sailboat that we do have now anyway. So that dream would have faded pretty quickly one way or the other.
Yeah, for sure. So, and now you're doing the life insurance and showing investors how they can leverage it. So do you want to give us a little bit of background on how that works, and then we'll get into some nitty gritty, just because, people like, even myself, I'm not really familiar with your particular strategy.
Well, the strategy is very easy to get your arms around. I mean, a lot of the people that I see on Bigger Pockets, for example, everybody wants to do the DRRR strategy, right?
Yeah.
Buy, rehab, sell, refinance, pull the money out, reinvest. Using life insurance is the same concept. It comes down to this. If you can put your money into an asset class that's growing at 6 to 7%, and you can borrow against that asset at prime, 5, then anything you do with that 5% money is adding value on top of what the fixed or original asset is doing. And that's what it comes down to. So the life insurance just adds the layer of complexity to it. I mean, it's the underlying asset that makes it all possible. But you can do the same thing by buying a house and then pulling the equity out of it. Same concept. You still own the house and you own whatever you're doing with that leveraged money. You can do it with a brokerage account.
Gotcha.
Here we're just using cash value life insurance, which is nice because the cash value is principal protected. You don't have to worry about it going down in value. And you can get a line of credit for about 100% of what you have in cash value.
Gotcha. Okay, so do you want to walk us through how you approach, let's say you're meeting with an investor. Do you want to walk us through how you approach that and how the investor can benefit?
Well, the investor basically can make more money doing whatever it is that they're doing. So if you use the numbers I just gave you, for example, it's not unusual for a whole life. Mass Mutual, Penn Mutual are paying like 6.3, 6.4% in dividends right now.
Mm-hmm.
That's the rate of growth that your cash value is going to earn in the policy. And we should maybe back up and cover a little bit like life insurance 101, so this all
Sure.
makes sense.
Okay.
But if you can get a line of credit against that asset at prime by 5.5 today, then whatever you are doing, let's just say your cash on cash return was 10% on an investment. If you're using borrowed money to do it, you make 10% on the investment, your cost of money was 5, you net 5% on that. But your cash value also made money, right? It grew at 6 or 7%.
Mm-hmm.
So you've got the spread there between what you're earning and what you're borrowing at. And then you've got the tax advantage of reducing your taxable income on the investment that you got.
Yeah.
So the difference ends up being like 2 to 3% higher. So at the end of the day, it all comes down to you have to understand that in a life insurance policy, there's fees, costs, commissions, all that, all the things that people hate about life insurance, right? But you're going to be left with some amount of cash value. So just to use round numbers, $100,000 premium will give you about $85,000 worth of cash value in a properly designed policy. So you're thinking, okay, I lost $15,000, that sucks. But that $85,000, if your investment is 10%, you can really make about 12, maybe 13% on that, because you're literally putting that $85,000 of cash value to work,
Mm-hmm.
as well as the $85,000 of borrowed money that you're using to invest at 10%. So it comes down to, if you understand compounding interest, exponential growth, would you rather have $85,000 growing at 13% or $100,000 growing at 10%?
Mm-hmm.
I mean, it may look like it sucks right away, but if you can ride the exponential growth curve, that $85,000 is going to grow at a faster rate and eventually be worth more than what $100,000 would be worth growing at 10%.
Yeah, for sure. And like you said, somebody watching this might not be familiar with life insurance. So, do you want to explain the difference between, the term life insurance and the universal life, and why we're talking about universal?
Well, we're talking about permanent life insurance. Permanent life insurance includes both whole life and universal. And there's a lot of people out there. There's holy words. I don't know if you follow it, but anybody who's into infinite banking, which is a system out there, or bank on yourself, or any of these types of systems, are adamant that you have to do this on a whole life chat. And I disagree. I mean, any permanent life insurance policy will work for this. So, life insurance 101. Let's start from the basics.
Okay.
Everybody can understand how a term policy works. You buy a 10-year policy for $1 million. If you're a 40-year-old, you're going to make it to 50 years old, right? I mean, you could get hit by a bus, but the chances are most 40-year-olds are going to make it to 50. So nobody's planning on using that. It's there as a backstop, and it's got no cash value whatsoever. When you reach 50 and you no longer have a policy, you've got nothing to show for it.
Mm-hmm.
With a permanent life insurance policy, the insurance company is going to pay a death benefit someday, no matter how long you live. Whether you live till tomorrow or to 120, you're going to get a death benefit to whoever your beneficiary is. So if you put yourself in the position of the insurance company, how would you design that policy? How would you design a life insurance policy to accomplish that risk? So if you're a 40-year-old, let's use the same numbers again, and $1 million death benefit, you know a 40-year-old is going to live to about, let's just say, 85 years old. So 45-year-old's got another 40. Did I say 40 or 45?
40, yeah.
A 40-year-old has another 45 years of life expectancy. So you would want the premium to be such that person will save their own death benefit over the course of their lifetime. And the money is not going to be sitting idle during those 45 years. The insurance company, since you want the client to save up their own death benefit, you want to invest that money for them and earn as much as you possibly can, right? You're not trying to screw them and take some of the return. The more they save, the faster it grows, the better for you, because it eliminates your risk of having to pay that $1 million. So when you see companies quoting a guaranteed rate of 4%, for example, well, that's not a real number. The company doesn't plan on paying 4%. They're going to invest that money to make as much as they possibly can. And 4% is just, it's their worst case scenario. If over those 45 years, what's the worst thing that we expect the bond market to do? And that's what the guaranteed rate is. Insurance companies never plan on paying that. They're going to pay whatever they make. And they're going to invest their assets in U.S. Treasuries, corporate bonds, municipal bonds. They buy a ton of mortgages, a little bit of real estate, a little bit of stock market. But for the most part, whatever the returns on the bond markets are is what you can expect the cash value of a life insurance policy to grow at. Just nice, safe, secure, principal protected investments. Make sense so far? Okay.
Yeah.
Now, the insurance company also has the risk that the client could step off of a curb tomorrow and get hit by a bus. So they might have to come up with that $1 million. So the other part of or component of a life insurance policy is what they call the mortality risk. It's the risk of having to pay that death benefit. So the way they accomplish that is simply buying a 1-year term life insurance policy inside the whole life policy. So if you think about it, on day one of the policy, you make the first premium payment, so you've got a little bit of cash value. But the insurance company has the risk of you stepping off a curb, getting hit by a bus, so they have to buy a 1-year term policy for $1 million on the side. But over time, as your cash value accumulates, now they only have to buy a term policy for the difference between the cash that you have, the amount of the death benefit that you saved up yourself, and what the death benefit is. So the cash value literally represents the client saving up their own death benefit. And the risk is slowly but surely being eliminated over time as the client saves up their own death benefit. That's the insurance cost, so to speak. So to get into the holy wars between whole life and universal life, the insurance company, like I said, puts their money into the bond market. They all do, whether it's a universal life company or whether it's a whole life company. They're all putting their money into the same exact asset. If you were to go out and pull up the annual reports for Mass Mutual and some company that does IULs, Allianz, you're going to find that their balance sheets are identical. They all invest in the same asset classes and pretty much the same mixtures. And you would expect that if the Moody's corporate bond index average were 4.5%, for example, you'd expect that most insurance companies are making about 4.5% on their cash value.
Gotcha.
So if you know what the expected value is, you care what the guaranteed rate is, they're never going to pay it. But a universal life company could have a guarantee of 0, and it's still going to do every bit as well as a whole life company with a guarantee of 4, because it just doesn't matter. Now, when I'm doing this, I like to use an indexed universal life. Now, the whole life guys hate indexed universal life. 1, because there's no guarantee on it. And then 2, they give you this argument of the rising mortality costs are going to cause these policies to lapse as the client gets older. So over time, simple logic, as you get older, the risk of dying becomes greater and the cost of insurance goes up, right? But they're neglecting the part I said earlier. As the cash value is growing, the net amount at risk to the insurance company is going down. So the cost of insurance inside the policy remains pretty constant for the entire term of the policy. And once you get outside the first 10, 15 years of the policy where the surrender charges are, the load on the cash value, like if you think of the cost of insurance as the expense ratio in a mutual fund, it's about 1/4% in a properly designed overfunded policy. 1/4% is nothing. I mean, if you're out there and you're earning 4 or 5%, you're netting 3.75. But it does not change the numbers drastically.
Yeah.
The cost of providing a 1-year insurance policy to an 80-year-old, the pool of 1,000 80-year-olds, the mortality rate could double, and all it's going to do is change the expense ratio from 1/4% to 0.5%. It's not going to cause the policy to lapse. So that's what's going on in both whole life and in universal life. What's going on in an index universal life is the insurance company is taking the interest that they earn from their bond holdings, and they're using it to buy as much movement in the market as they can get purchasing index options. So when you see an index universal life policy quote, you're going to see something like it's got a cap of 12% and a floor of 0. So if the market goes up, the S&P 500 index goes up 12 points, your cash value is going to earn 12 points, 12%. But if the market goes down 20, you've got a floor of 0. You're not going to lose any money. And that's the underlying options. It's just like options on real estate.
Yeah.
If you've got an option to buy a house you're talking to a seller and he's worth $100,000, you might give an option for 105, right? If it goes up to 110, you exercise that option, you capture the 5,000, and
yeah,
you have the cost of that 5,000, but you capture another 5,000, right?
Yeah.
Same thing here. If that house went down to $90,000, you just wouldn't exercise the option. You lost what you spent on the option, but you just don't exercise it. So 0. And that's what's happening when you see an IUL with a cap of 12% and a floor of 0. You have the option to get whatever the market gets during those 0 to 12, but you can't get any more than that because that's where the option is going to be exercised.
Yeah.
But if the markets crash, you're not going to lose any money. All you lost was the interest from the bond holdings that the insurance company used to buy those options on the market. I know there's a lot of complicated financial detail right here, but the key of all that is that the cash value on an IUL has the ability to earn a portion of what I call the equity premium. Everybody would expect that the stock market average returns are going to be greater than the bond market, right? The bond represents a company borrowing money, so the interest on it is a business expense to that company. It gets paid before there's any equity left over for the owners. The equity markets are that equity portion. So that's the people who are taking the risk. So greater risk, greater return. And the IUL allows you to capture a piece of that equity premium. So 2 identically designed policies, whole life and IUL, they're going to look identical. They're going to start off with the same exact cash value, the same amount, same cost of insurance. But over time, the IUL, the cash value, has the opportunity to grow at stock market type rates of return without the risk, whereas the whole life the returns are going to be equal to whatever the returns in the bond market are. So when it comes to a long-term planning horizon, the IUL gives the user the ability to have his cash value growing at an average rate of 7.5%, whereas they're borrowing at prime, which is currently like 5.5%, 5.25%, and then they can reinvest it into whatever they're putting their money into on the real estate side.
Gotcha.
Just buying a simple note at 10%, you capture that spread between the equity premium and the borrowing rate, which is, let's call it the debt return. And then you're also getting the tax savings from reducing your taxable income on the real estate side.
Gotcha.
So that's really it in a nutshell. I mean, just understand that the two types of policies, they're nearly functionally equivalent. It's just that the IUL, if you can get your arms around the fact that the returns are linked to the equity markets, is going to earn a greater return over time with no loss of safety or security.
Gotcha. So let's say, a person's younger, they want to get into buying some real estate properties, turn it into a portfolio. At what point would you suggest they start thinking ahead for insurance with how to, tap into that at a later date?
I'm not sure I follow your question.
Yeah. So
this is a long-term philosophy. So, I mean, to the extent that anybody is going to take their money and invest in real estate, if they combine this with the real estate investing, they will accumulate more wealth over time. It will. I mean, there's just no way it's not going to happen.
Yeah. No, I think I was just asking, being able to borrow from that insurance policy. Obviously, there has to be enough cash value in there to borrow it from, and that's going to be further down the road. So basically, what I was trying to get at is, you're looking probably 10 years in the future before there's something decent in there for you to tap into.
No, I should let you talk to some of my clients.
Okay. All right.
When you're so the life insurance 101 discussion is basically paints a picture of how a life insurance policy works, and that's what I consider an underfunded policy. So if you call up an insurance agent and you ask for $1 million policy, you're going to pay the least amount of money to have that cash value grow and accumulate to be your death benefit essentially by the time you reach your life expectancy. The world I play in is called overfunded life insurance policies. So now you're paying the most to get the least amount of death benefit because the objective is the cash value. So these are the polar opposite of true whole life policy. So I won't get into the technical details. I've gotten technical enough on this. Just suffice it to say that, again, using my numbers from before, if a client that I'm talking to has $250,000, $250,000 of savings, and they've been investing in real estate and they came across this strategy, then I would design a life insurance policy that would take about $50,000 a year of premium for 5 years. And then that policy would be paid up forever. I mean, you'd never have to put another dime into it unless you wanted to. And I'm solving for the minimum possible death benefit compliant with the law. So that $50,000 premium is going to result in about $40,000 of cash value. That's accessible immediately, not 10, 15, 20 years down the road. I mean, just right away. So the client, from his perspective, he's got $250,000 in the bank. He writes a check for $50,000 for the first year's premium, and he's got basically a line of credit immediately for $40,000.
Gotcha.
Plus, he's got the other $200,000 sitting in his bank account that he can. So he's basically down 10 from what he had before. But by the time he's 4 or 5 years into it, he will have gotten all of that $250,000 into the policy, and the cash value of the policy, assuming about a 6% growth rate, will be back to $250,000. So you're dead even at that point.
Yeah.
So the other side of it would be somebody who has no money. So they're listening to your podcast and they're just getting started in real estate investing, and they can save up about $1,000 a month to put into real estate investing. So as a financial advisor, I mean, I want a client to have some kind of reserve fund first and foremost. Before you do any real estate investing, you should have 6 months of personal expenses, enough to sit in the bank, whether you're losing a job or anything. Then you can start worrying about saving for real estate, saving for retirement. But assuming somebody could save $1,000 a month to invest in real estate, then I would simply design a policy around $1,000 a month. And of that $1,000 a month, the same ratio applies. About 85% of that's going to go to the cash value, and about 15% of it's going to go to the expenses. And keeping in mind that after the first 10 years are up, those expenses drop from that 15% down to only about 5.5%, 6%. So you lose about 5.5%, 6% of every premium dollar that you put into it.
Yeah.
But you can put that money to work in 2 places at one time. So when you can use it is more a function of when do you have enough cash value and investments that match, right? So whether you're putting the money in the bank just to write a check to invest, or whether you're putting into a life insurance to invest later, you'll invest when you're ready and you have enough money.
Gotcha. And are you seeing more and more investors, real estate investors, adopt this approach, or just because most people might not have heard of doing it this way?
I wouldn't say it's a lot. I get maybe 4 or 5 people a week that find me, reach out to me. Generally I've got a link on my website where somebody can just basically set an appointment with me. So it shows up randomly on my calendar, and I have a nice, fun conversation with somebody that's, watched all my YouTube videos, read all my blog posts, and they come to the table ready to geek out on life insurance. Now, see, your listeners, they're getting ready to listen to something on real estate, and now I just totally overwhelm them with technical knowledge on life insurance.
That's right.
But everything that I've covered here with you is like the same conversation that I'm having with somebody when they call in, because it's just basically that life insurance 101 is enough to fill in all the gaps. People don't really understand what the cash value of a life insurance policy represents until they hear it that way.
Yeah.
It's literally you saving up your own debt.
Yeah, for sure. And I'll be sure to include like the 5 pages of footnotes at the end. And I think the one thing too, like I live in Toronto, so I'm in Canada, but I believe the insurance policies are very, very similar both sides. Most of my viewers are in the States. This might sound like a very stupid question. The payouts, if I choose to take at the end of, once I have all the cash value, if I choose to take it out, that's all tax-free still in the States, right? So,
well, when you say take out, I mean, there's 2 ways to access, well, 3 ways if you count dying and your beneficiaries getting the money, but
yeah, there's
2 ways to access the cash value in a life insurance policy. One is to take a withdrawal, where you literally take the money out of it.
Mm-hmm.
And that, to the extent that there's a capital gain, you'll pay tax on that gain just as if it were an investment.
Mm-hmm.
But why would anybody ever take a withdrawal when they can access the cash value via a policy loan?
True.
And I should clarify, when I'm talking about a policy loan, this is not you borrowing your cash value out. This is literally the insurance company loaning you money with your cash value as a collateral. So your cash value never leaves the policy.
Mm-hmm.
You can just, in fact, I recommend to my clients, don't take a policy loan for real estate investing. Go to a bank and get a line of credit. And what the bank wants for collateral is an assignment of collateral against your life insurance policy.
Gotcha.
And unlike foreclosing on a house or repossessing a car, if you default on that loan, it's very easy for them to secure their collateral.
Mm-hmm.
You can't run off with it when they have an assignment of collateral. So that's what gets you the best possible rates from these third-party banks.
Gotcha.
And the key here is that interest becomes tax deductible as a business expense. So let me just put that into perspective so your listeners can grasp the beauty of what I just said, because I know it's not yet.
Yeah, and I'll just throw in. So I'll just throw in, if somebody's listening, I just had a big smile on my face for the tax rate off the interest. So I see where you're going with this.
Well, if you have an investment that you can make earning, let's just say 10%, you could buy as much of a note as you want and then earn 10% on it. And your cost of money is 5. You can borrow as much money as you have collateral against the policy at 5%. So you stand to make 5% on your investment. So if you take a policy loan where the interest is not tax deductible, you make 10%, and that entire 10% is taxable income. So let's just say you're in a 40% tax bracket. That 10% turns into a net of 6%. And then once you pay the insurance company back for the loan, you're left with 1%.
Yeah.
Hardly worth getting excited about. But the same model, if the interest is tax deductible, you make 10% on your investment. The first 5 is a business deduction as you pay back the loan. So you're only paying tax on 5. Well, 40% of 5 is 2. You walk away with 3.
Mm-hmm.
3 or 1. Great,
Yeah.
right?
Yeah.
I mean, that's triple the income by just making one strategic improvement in your business model.
For sure. No, and I think that this is the kind of stuff that most people don't hear about during the regular course of their day, unless you're really looking or talking with somebody like yourself who knows how this works. So I think this is really beneficial, not just to real estate investors, but basically anybody.
Yeah.
Yeah.
Well, I didn't get into the origin story on this. I mean, that's kind of interesting too, because
Okay,
in your intro, you painted the picture of me coming down to Florida wanting to live on a sailboat for the rest of my life. Well, when reality got smashed on the rocks, so to speak, I put all of my money to work, tax liens, different investments, and I really didn't want to be a house flipper. We had done some flips and stuff like that, and I was just tired of looking at analyzing deals that didn't make sense, walking through stinky, smelly, dirty houses. That wasn't the life that I wanted. So that's when I decided to get into financial services, which was chasing a dream that I had back before I even went to college. And like the first day on the job at an insurance company, this company focused on overfunded life insurance policies for tax-free retirement. So right from the get-go, I was with a company that sold IULs and was used to designing high cash value policies. And my immediate thought was, so I don't have to wait years for the cash value to grow and accumulate. I have it right away. And I can get a loan for as much as I have. And then by this time, I know what the cost structure is, that you're actually in a properly designed policy. The fees aren't nearly as high as they are in a traditional whole life. So my first thought was, would it make sense for me to put my money into life insurance and then leverage against that life insurance to do my real estate investing? And I went home and I read through all those life insurance documents that I had to get a better understanding of how it all worked. I built a spreadsheet, and that spreadsheet is the same one with a few modifications over the years that I use every time I sit down and present this to a potential client who's interested.
Yeah.
It's the same one. I mean, it shows the values of a life insurance policy right alongside if you were to borrow against that policy's cash value and invest it at whatever rate you want to assume, this is what you'll accumulate over time. And it works.
Yeah. No,
it works in every case.
That's huge. So where can somebody get in touch with you if they're looking for some more information or if they just want to have a conversation?
My website is innovateveretirementstrategies.com. It's pretty long, but it's easy enough to remember. Innovative Retirement Strategies.
That's perfect.
And there's a link on there that somebody can use to book an appointment on my calendar, and I'll call you at whatever time works out best for them.
Sounds good. Perfect. Well, Tom, just want to say thanks so much for sharing that with us today. It was actually it got technical, but it was really informative.
Well, you've had a grin on your face the whole time, so I think you've been having fun.
Yeah.
I'm not the life insurance agent that calls you up at dinner time, right?
Yeah. Or duck cleaning. So.
Yeah.
Yeah. No, that was really good. I learned a lot. So thank you very much for your time.
Oh, my pleasure.
Yeah. And
thank you.
Yeah, you're very welcome. And to you, our viewers, I wish you well on your journey from purchase to profits. See you next time.